My question regards financial institutions and the potential of collapses, and how is Berkshire protected, and how can the individual investor protect themselves against potential bank failures, stock brokerage failures, and things like that?
Well, I think as a depositor with large banks or as somebody that leaves their securities with large brokerage firms, I really don't think you need to worry very much. We have a too big to fail doctrine operating in this country relative to what you might call the innocent parties in big financial institution failures. We don't have it in respect to the equity holders, nor should we have it. But I would not, I don't worry about leaving my securities, my personal securities, or for that matter, Berkshire securities, with the large securities firms. I don't worry about my bank accounts at big banks. So,
but you're talking cash accounts.
Yeah, cash accounts.
Not margin.
Yeah. And but if you, in terms of owning the equities of companies like that, or in terms of the fallout, the big thing that will, really the only way a smart person that's reasonably disciplined in how they look at investments can get in trouble is through leverage. I mean, if somebody else can pull the plug on you during the worst moment of some kind of general financial disaster, you go broke. And Charlie and I both have friends that have, where that's happened to them. But absent leverage, and absent just kind of going crazy in terms of valuation on things, the world won't hurt you over time in securities. I mean, you won't be subject to the financial cataclysms that they don't need to do you in. If you have any more money during periods like that, you buy. Berkshire, I think, is an extraordinarily strong position in respect to any kind of a financial cataclysm. I think we would be definitely the last man standing and then some. And while we don't go around, like undertakers looking for a plague or anything like that, we would probably do very, very well in the end. And that's happened a couple of times actually in the past, where we've had cash and we've had courage when the world was panicking, and we've done reasonably well during that period. And we've never gotten hurt by what was happening in the world around us, at least in the last 30 or 40 years. Charlie?
In the old days, the only way you could stop a run on a bank was basically for somebody to come and pile up gold. I mean, they used to race it to the branches that were having a problem. I remember reading the history of the Bank of America on that and how they would put out runs before the Federal Reserve existed. And the only thing that stopped it was to pile up gold. I mean, if the CEO of the bank came out and said, our Basel II ratio is 11.4%, the line would just lengthen. It would not get the job done. Gold got the job done. Bernanke and Paulson got the job done. But the only way they got it done was saying, we're guaranteeing new commercial paper. We're guaranteeing that the money market funds won't break the bank. We're going to do whatever's necessary. I think Dodd-Frank weakens that, and I think that's a terrible thing to weaken.
We bought all of a bank in 1969. We bought a bank in Rockford, Illinois. Charlie and I went and we must have looked at a half a dozen banks at that, in a 2 or 3 year period.
Absolutely.
Yeah, we trudged around and we found some very oddball banks that we liked. And they were characterized by very little risk on the asset side and very cheap money on the deposit side. And even Charlie and I could understand that. And low prices, incidentally, too. And then they passed the Bank Holding Company Act in 1969, and they killed off our chances to do anything further in buying all of banks. So we look at banks. We will own bank stocks from time to time in the future. We'll probably buy stock in other banks. We've also seen all kinds of banks ruined. I think it was, what was the fellow, M.A. Shapiro, who came up with the statement. He said there are more banks than bankers. And if you think about that a bit, you'll see what I mean. There have been a lot of people that have run banks in a very injudicious manner, but that's made for opportunities for other people. A lot of banks have disappeared over time. I mean, up in Buffalo, where Bob Wilmers runs M&T, there were some other very prestigious institutions that went right down the tubes, and a lot of that happened in the early 90s or late 80s. So I wouldn't look for a single metric like relative PEs to determine how to invest money. You really want to look for things you understand and where you think you can see out for a good many years in a general way as to the cash that can be generated from a business. And then if you can buy it at a cheap enough price compared to that cash, it doesn't make any difference what the name attached to the cash is.